Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about what's keeping mortgage rates from falling and why Americans don't have to worry about the dollar crashing. Logan, welcome back to the podcast.
Sarah Wheeler, you're back. You are back. You left the country because your fantasy football team was 1-5. And oddly enough, I'm 6-0, and I'm 6-0 without having Christian McCaffrey for 1 week. I'm leading the league in scoring. I don't know if you're in last place, but I think you're there. And we're going to play each other this weekend, which means in the history of fantasy football, this means you'll probably beat me. It'll probably be your only win or second win of the year.
I can only hope.
The Super Bowl.
Okay, so me leaving the country is directly resulted in me forgetting that I needed to look at my team and reset things. People were on buys, people were benched. It was awful. It was bad.
It's a lack of commitment. This is why I always say to the housing crash people, do you really want to go head to head with me 24/7 when you know how committed I am to winning?
It's true. It's true. I should always think about that. Oh my gosh. Okay. Well, we have some really important topics today, really talking about the larger picture around mortgage rates. And the first thing I want to ask you about is the Federal Reserve, because we've had them coming out this week talking about things like it just feels like they don't like housing.
So we had this premise a while back that, the Fed doesn't care about housing. They've kind of just stepped away, and they kind of make haphazard comments for a while there. They're like, oh, the housing market's recovering. Demand's no, right? The housing market, we're not going to, we don't think about the existing home sales market or anything, or we don't believe that low mortgage rates were the problem. They have some obscure statements, and to be honest with you, they're not housing people, right? They're the Federal Reserve. They're not like digging to the trenches housing. So here it is. It is the third calendar year of the lowest home sales. And I'm saying this in all honesty, because if I adjust it to the workforce, it is. But whenever mortgage rates get down toward 6%, it's happened twice now, we do get a forward-looking positive demand curve that's about 12 weeks, which means that it's material. And then rates pop up again. And there's no comments or anything about it. And I think, now we've done the NER tour, in 6 different cities recently. This is one question. Why doesn't the Federal Reserve say anything about housing? So in this regard, they don't make policy around the housing market if it's not impacting the economic or labor data. And, the pushback that I get, going around the country is that, well, the last time existing home sales were this low, the Fed did zero interest rate policy, they did all this stuff to boost home sales. Well, it's not that economy. The great financial crisis had, we had foreclosures, bankruptcies, it's a much different economy back then, but it's also a much different world back then. We have to think of global bond yields and global Federal Reserves around the world. And we just don't have that kind of zero interest rate policy or anything to get mortgage rates back down to those levels. So you shouldn't even think about that. But why haven't they said anything now that mortgage rates have popped up again? Purchase application data came out this morning. It's Wednesday morning. So 7% week-to-week decline. We're still showing positive year-over-year growth, very low bar, right? Last year, we were running toward 8%, but nothing. There isn't a statement from the Federal Reserve that says, we would like the existing home sales market to grow. And because they would have to talk about even getting more dovish than what their restrictive stance is. And I think people should just look at it at that. They just want to make sure that the economy is still expanding. And as long as the growth rate of inflation stays low, they don't mind cutting rates. But to get to that next level, that's going to take something. This is why I always say labor over inflation. The labor data has to get weaker for the Fed to commit to that next stage. And so far, we haven't had that. And this is why it's been hard for me even to forecast anything below 5.75% mortgage rates. The same thing last year, same thing this year. We're going to have our forecasts at the end of the year, because their policy is actually very restrictive to housing in its current state. If affordability was much better, like it was in the last decade, we'd have a much different story. But that's not the case. Home prices escalated out of control, then mortgage rates escalated out of control, and we're still elevated because the labor market hasn't broken. And this is why we're kind of up here with the 10-year yield. We're still above 6% mortgage rates, even with the growth rate of inflation falling. So people have to look at it in that way, that their mandate is never about the existing home sales market. The new home sales market, on the other hand, actually facilitates economic cycles, permits, and everything. And we'll see, I don't think we're going to see it in this week's housing starts data or builders' confidence. But going down the line, does this increase in mortgage rates change that, where we're just not going to be buying homes or making a lot of homes anytime soon while we still have this policy?
So I think it's natural for people in housing to look to the Federal Reserve to solve the problem that, from their perspective, they created, right? So, we had those really low rates, which was part of their policy, which benefited us. And then the extreme rate hikes that we had in a 6-month period that were just unprecedented put us in the situation that we're in. So I think that it's natural to think, well, you got us here, they're going to get us out of this.
It's being part of team higher rates early in 2021, not a popular thing, of course.
Not popular.
But I think people forget, in the last decade, we had 3.25% to 5% mortgage rates in a range, pretty much for a decade. We never saw home prices escalate out of control. We never saw home sales escalate out of control. And back then, housing was more affordable. Household formation, wages rising, these things put together creates housing demand. We also have to remember that we had a lot of homes underwater. I don't believe in a mortgage rate lockdown, but an underwater lockdown makes sense, right? If you don't have selling equity, you can't sell unless you got to bring the difference. So in this regard, I think there's a lot of people that just forget that we had very low interest rates for a decade, and mortgage rates went a little bit lower than that point. Home sales never really took off like it did in 2002 to 2005. We had a lot more existing home sales and a lot more new home sales. But inventory broke to an all-time low, and it created the unhealthy to the savagely unhealthy housing market. Prices escalate. So in their eyes, they see this as, well, this is kind of normal, and we don't need to say anything until the labor market breaks. And then, again, they're always going to anticipate the long end of the bond market doing a lot of their heavy lifting. The problem here is we need sub 6% mortgage rates to grow sales in any meaningful way. We don't have policy for that. But what we could do, this is why I harp on this all the time, you don't need 3, 4, 5% mortgage rates. 5.75 to 6.25, just getting down there. And we'll see at some point, is that something where the Federal Reserve can accept? Because one thing that hasn't happened, I haven't seen Neil Kashkari come out and go, oh my God, people are buying homes again. Now we're supposed to fix the economy, And it's just like, okay, so we're past that stage, which is a positive. But again, we're bounded by where the Fed funds rate is, where the spreads are, and where policy is. It's really hard to get to the next stage unless you have the labor market get. And I say this because in the last decade, when I started to incorporate my forecasts with bond yield ranges in 2015, I had the same forecast every year. It's like 1.6 to 3%. We're just going to go back and forth until the next recession hits. We find ranges to teach people how to do the slow dance, right? It's all about the slow dance with the 10-year yield. So then people don't focus on, well, if the Fed cuts rate, mortgage rate, rates went up. We try to get people to focus on the economic data, because that's kind of how the Fed looks at it. If jobless claims are rising, the Fed could be more dovish, rates can go lower, home sales could pick up, people can refinance. That would be beneficial to the economy, at least in their eyes, in a weakening economic state. But we're right there in this very funky timeline with the Fed that I get it why people just go, why don't they say anything? It's not kind of their thing. Existing home sales isn't what they're worried about right now. The labor market and inflation and the new home sales market is more key to them into keeping that kind of employment level at bay.
So you've been very clear that it's labor over inflation. And you just said if the labor market breaks, then that's where we could see lower mortgage rates, right? So what is your prediction for, are we going to see that? Does that happen between now and the end of the year? Does that happen in 2025? Or do you think we just go up from here as far as the economy expanding?
So I always go with a trend rather than one or two reports because we've seen this time and time again every single year. There are one or two or three reports that beat estimates. There's one or two or three reports that miss estimates. And then people make too much about that one report and forget about a trend. The trend is slowing down. The labor market is slowing down. We get into these visceral, crazy debates about, is this a recession? Is it not a recession? Listen, if it's a recession, jobless claims rise. You just keep it simple like that. Okay. We have all these people doing all these, fifth or sixth variable economic cycle work, and they've been talking about it for the last 2 or 3 years. It hasn't created a recession. So labor data is getting softer. But again, a few things that we always say: the Federal Reserve, wants job openings at 7 million. They're content with 8 million because the internals are getting weaker. The Federal Reserve would like to see wage growth at 3%, right? Wage growth is the last wage growth number was so much on a month-to-month basis that I don't even believe it. So wage growth are starting to head toward that level. We're not there yet. Those things tend to happen when the economy is getting weaker, and then the job growth starts to slow down. Manufacturing jobs are lost. We've had 2 months of negative manufacturing. Construction workers lose their job. Take that, and then we go into the real recession talk. Because let's be honest here. Since 2010, 99.9% of the world has been garbage on recession calls. I mean, absolutely smelly, dirty garbage, right? It's like the movie Poltergeist. They're the dirt where all those bodies were still buried. They built those houses over and they pop up like the pool, and then that's what it is. So you have to go in stages and variables, and then when it happens, it's actually not very difficult to spot. Jobless claims rise, construction workers lose their jobs, manufacturing lose, industrial production. So we're not quite there at that point, but we are getting softer. So this is why we track everything every day, all the labor data, to get us to a stage. Because the difference now is last year we're heading toward 5% mortgage rates. Last year, the spreads were bad. Last year, we had a 5% 10-year, we had an 8% mortgage rates. The Fed was like, oh, the economy is outperforming, and we need confidence. We're in a little bit of a different stage now, but also global markets, right? Oil prices have fallen this week. They talked about, having an oil surplus, right? Not enough demand for 2025. England had one of their inflation reports come in much lower than anticipated. Their economy is doing worse, so they might talk about getting a bigger rate cut. So everything kind of moves in this big world economy that nobody cares about, but people like us will track it. So when we get to that next stage of weakenings, we have labor triggers, and we go with it. We're not quite there yet, right? Softening and breaking are two different things. Softening, door, right? Hold the door, hold that 380 line. Breaking, no. Wall's going to be broken. Hordor's going to turn to a White Walker, and then he's going to go to the wall and have that dragon open we're not quite there, but we're in a much better spot this year than last year, considering that, mortgage rates were at 8%, and, you're not going to get anything done in that light. So I'm hoping that in 2025 will be the first year the Federal Reserve does start to make a little bit more positive comments toward the housing market. But it's been brutal the last few years, right? You have the biggest crash in home sales ever in the second half of 2022. Your third calendar year of record low levels of sales. But I always harp back to this one talking point. We have near 5 million total home sales last year and this year, because the new home sales market is growing. The new home sales market itself, if I was to equate it to the existing home sales market, sales would be under 300,000 today. That's a lot. Permits are rising. We're firing workers. We're in a recession. That's not the case. So the existing home sales, new home sales together were near 5 million. The peak in the last decade was near 6 million. So in the Federal Reserve's minds, they think, okay, we're missing 1 million home buyers from the previous decade. And in the previous decade, I didn't think we can ever get total home sales above 6.2 million until our demographics got a little bit. That was the years 2020 to 2024. We were able to achieve that, but I'm not a sales boom person anyway. So think of it, the Federal Reserve looks at it like that. And again, they don't make policy around the existing home sales market. At some point, they could change that. They could say, okay, we want home sales to grow. We're just not at that stage yet. So if you're confused about the Fed not saying anything, this is why. It's not part of their mandate.
So, okay, so looking at how rates could go lower, of course, if the labor market breaks, then we get lower 10-year yield, which means lower mortgage rates. And we also, so the bond market can get ahead. We can have the Fed do it. The other way is the spreads. So maybe talk about what you're seeing with the spreads, and if we could see some lower mortgage rates through that.
So we have a lot of questions on the spreads because not a lot of people know about the spreads, right? I bring these charts up at these events. I go, does anybody know about the mortgage spreads? There was like a few hands right now. Okay, so let's go back to the 1970s, early 1970s. Why do we always talk about housing in a slow dance, right? The 10-year yield, 30-year mortgage rate, slow dance together. What drives that? But I always say sometimes the slow dance is very intimate, right? Sometimes the slow dance is a little bit far back. Footloose. Did they know? They didn't allow dancing in Footloose, right?
No, I don't think they did.
No, okay.
All right, but the idea of like having
it's just like,
a mentor being like,
So when the spreads are bad, it's a Footloose slow dance. Not very intimate, right? When the spreads are good, it's kind of Logan's version of slow dancing. So every single time mortgage rates rise, they have a big spike, right? The business of doing mortgages is at risk. Why? Because if you I'm gonna try to dumb this down as simple as I can. I'm going to pay you $10,000 for this 7% mortgage rate. I need to keep it for a certain amount of time to make money. But wow, boy, this is really at a risk of getting refinanced. So there's no more prepaid penalties. I'm going to lose money if this thing gets refinanced. So the spreads get wider when mortgage rates jump up really fast, but also when there's market stress around. If you look at the spreads going back to the 1970s, there's charts on this. You can see periods and times where the spreads get really bad. They don't get terribly bad at all recessions, but we in the early 1980s, the spreads were 6%. That's how you got 18% mortgage rates back then. But now we talked about earlier this year that the closer we get to the first Fed rate cut, the spread should improve. They have. They actually started to improve a little bit earlier than I thought. We still have a kind of 75 basis points left just to get back to normal. Now, we've had spreads under 1% even. So if you wanted to even go that route, we have a lot. So the spreads is the second way that mortgage rates could get better without too much help from the 10-year yield. So, of course, labor market's number one, spreads two, or maybe in 2025, maybe that'll be the year. The Federal Reserve says, hey, listen, this is the fourth calendar year of the lowest home sales. And Logan says that a healthy country, people have sex, they buy homes, they have kids. This is how it's done since the Peloponnesian War. And we have a massive, massive young workforce, right? So one of the things I tell people on the nerd tour is if I told you there's more Gen Z workers than baby boomers, do you guys believe me? And they're like, what? Like, baby boomers have to work? No. There's like 17 million baby boomers left working. Gen Z just recently kind of right at that edge surpassed them. Millennials double them, right? Millennials are massive. Gen X, us, the Chart Daddies crew, nobody cares about us, which is good. we want all the drama to be between the millennials and the boomers, and we just kind of do our own thing. So we have a huge replacement workforce, right? This is why I always say demographic replacement demand. I'm not a demographic boom person, but replacement, we could go. Young people buying homes, having sex, having kids. This is how a country grows. And when the cost, right? Because everybody keeps on saying, home prices have to come down at 40%. It's like, when in history has that happened? McFly, major distress sales around the world. Right? Not around the world, but in America. 2007 to 11, we don't have that. So you have to create something else to bring big national home price declines. Not here. So rates going down a little bit just gives you a little bit more leeway for the young households to get in there and start their life. And as we can see, homeowners, it's such an unfair advantage. When I do these nerd tours and I show everybody how well homeowners are doing, there's just like this, oh my God, I didn't know. because there's these around on YouTube saying everything's terrible all the time. It's just not the case. So hopefully 2025, we'll see. We'll cross that bridge, but that'll be the time where you could get maybe a little bit more positive tone by the Federal Reserve, because it's not obviously the case here. I loved it how Jerome Powell was, I think 8-9 months ago, he said, the housing market is subdued. No, homie, it is the third calendar year of the lowest home sales ever. You can't go any lower than this. It is. You're digging another grave down there. You're putting another end. So if people, I know a lot of people are just confused about why don't they say this is their mandate. They don't make a mandate around this. And the same thing for the crazy crowd people that said they can't lower mortgage rates. Home prices will go up. Home prices have been going up since the Peloponnesian War. It's very rare for nominal home prices. Could you imagine if you said, we have to keep mortgage rates at 20% because home prices might go, no. Our country, our middle class, our superior middle class, our middle class has actually expanded more because we have more people making more money. The homeowner financial profiles. You guys all see it in the chart site. Nobody does it better than us in America. They all hate us around the world for this. So we'll see if that could be the case. But I've always said, just remember those three things: labor market first, spreads getting better, Federal Reserve getting maybe a little bit more dovish, but kind of keep that hoarder line, right, at 380, and then 5.75% on the 30-year mortgage, kind of getting underneath there. It really needs another help from those three variables right there for that to happen.
Okay, I just want to point out the breadth of your pop culture inclusion in this episode. So we've had Game of Thrones, we have had Footloose, and we've had Back to the Future. Pretty impressive right there to get all three of those in a short podcast.
Yes, and not a lot of people like the hoarder line, by the way, but not a lot of people like the Gandalf line. So for those that are new, we have a lot of new people. The Gandalf line was created last year, and I was like, we're not going to break under 3.37. You shall not pass. So
that's on the 10-year yield, right?
Yeah. So we're the labor market has to break. It's not breaking. Here, the hoarder line was created around 380, and say if we get underneath here, you need labor deterioration, and to make that next move lower, you're going to need all these things to happen. So that's why it's created. The 10-year yield, by the way, this morning, under 4%. We all survived. Again, we all survived the 4% 10-year. I know some mortgage and real estate people don't think that, but just as a country, the scared crybabies of America, whenever the 10-year yield got to 3% in the last decade, they're going, oh my God, we're going to crash. These crazy people thought we're going to have a housing bubble crash in 2018 with 5% mortgage rates. Do you guys realize how terrible these people are? Just dreadfully awful. And they're dreadful on purpose. These are not housing analysts. None of these people model anything out. You can just see this by they talk, and they don't shut up. They just talk. So 4% 10-year, obviously people freaked out. They thought the world was coming down. 5% 10-year, right? The end of the world, right? Oh, nobody's going to buy U.S. debt. We're broke. I get all these, we're broke country. By the way, we had a Brics question in New Jersey.
Yes, we did. All right,
so people brought up the Brics, a dollar class. I was like, somebody give me a...
So first, say what Brics is. Not everybody knows what Brics is.
Okay, so this is basically the fake currency that's going to destroy the dollars from Russia, China, India, Brazil.
So it's like Brazil,
by the way,
Russia.
Yeah. Cuba actually asked to be part of this group. Oh boy, we better watch out now. Cuba's going to come in. So I was like, hey, you guys see that trash can over there? Somebody get that trash can. Give me a piece of paper. Somebody give me a piece of paper. Brics, dollar class. I'm going to throw it in there. I was like, did you guys hear the news about Russia recently? Chickpeas. Their currency, their money system is terrible that they have to trade with India. Chickpeas for tangerines. And this is supposed to be the dollar collapse group? Really? And nobody ever talks about, well, the euro is going to collapse, or the Mexico peso is going to collapse, or the Canadian. No, it's always a dollar, because this is an ideological take. This is a group of people that are crazy. They've been crazy after 1913. They were born in the wrong century. These people living after 1913, as the Federal Reserve was created and the U.S. became a superpower, it drives these people nuts. I understand why the Russians hate us. I understand why the Chinese hate us, or whatever. I get that. When we got American people talking, the BRICS are going to come in and destroy the dollar. I'm like, okay. I was like, by the way, everyone just remember, when the dollar collapses and the Mexico peso goes up, Mexico will buy California. The Canadians will buy New York, right? Nothing will happen to the euro but us, the biggest economy in the world, the biggest military, friendly neighbors, 2 oceans, reserve currency, $185 trillion in financial assets. We're the ones that are in trouble. If you have a BRICS friend, mute them. Zero hedge, or we call zero brain dead. There's just a group of people in this world. I kid you not. I've been saying this. How long we've done this podcast? Like whatever, 3-4 years now. These people will cry about living in America till the end of their life. They're going to go out to the afterlife. And even in death, in the bottom of the abyss, they will scream about the Fed's balance sheets and the BRICS and everything and the dollar collapse. No, ain't going to happen.
Well, and I think it's great that, when people bring this up on the road, and I've heard it every time that we have had an event, right? When you're speaking, it shows that like they don't know what to think. And they might be, it's hard to know sometimes who to listen to, who not to. And that fear driven thing of like, is the dollar going to collapse? We hear that quite a bit. So I'm glad that you are here to just be very emphatic. You were very emphatic at the event. You're like, throw it in the trash. That take has nothing good about it. So it's good.
Sarah Wheeler, when I die, they're going to say he played ball 24/7 and he was very pro-America. When these people pass on, smelly, bad. So this is the world we live in. Some of us chose, because I've always said, I criticize the academic world for not doing a good enough job of realizing that there's so much misinformation about the United States of America. I understand where Russia and China does it, but it's domestic here. We have a lot of crazy domestic people trying to get attention. It's our job to fight back on it. Nobody wants to do it. So I say, raise my hand. Let's do it 24/7. Economic cycles come and go. But anybody with models is not a perma anything. But this group took it to another side, to the dark side of hell. And not even the devil says, man, dollar collapse, really? Russia? No. Okay, go. Chickpeas. Chickpeas in Cuba. Oh, we better watch out. Sarah Wheeler, we better watch out. Do we have enough chickpeas?
We may not have enough chickpeas. Logan, thank you so much for being on. We will continue to watch this. I know you're watching it all the time as far as where the labor data is going, because that's going to affect so much. And thanks so much for being on.
Good to be here, Sarah Wheeler. I'm glad you're back, and I wish you the best this weekend because I'd hate to come back here next week 7-0 and go, boy, doesn't look great.
Listen. I may have to bring in some reinforcements to help me with.
Yeah, go to that player wire. That'll help you out. Go get Cam Akers. There you go.
All right. I'll talk to you soon. Bye.